Okay, thanks everyone for joining us today. Can everybody hear us or hear me? Okay, great. Great, okay. So just some house cleaning stuff. We have quite a few people sign up, so we're gonna give maybe three or four more minutes until most people join. You can see there's a chat panel. There's also a Q&A panel. So if you have any questions, please disrupt us. If you have any questions along the way, do not wait until the end. We have a host, Shirley, today. She's gonna moderate and she's gonna bring up any questions that any of you may have during the whole process. We're gonna cover a lot of grounds today. So if I'm too fast, if there's anything that you need more clarification, please type in your question and we will answer it right away. At the end, we will have a Q&A where we can open up the mic for anybody who wants to ask questions as well. Okay? And while we're waiting, if you guys already have some questions, feel free to type as well. Okay.
Hi, everyone. This is Shirley. I will be the host of today's webinar. And if you have any question, like Cindy said, please don't hesitate to type in the chat panel. Meanwhile, we will leave about 20 to 30 minutes at the very end of the webinar to answer all the questions. So at the end of the seminar, you can just raise your hand easily from the choice below your screen. And then we will open your microphone to talk directly with us. Thank you.
Yeah, but in the meantime, if you have any questions, just type. We're gonna try to address as many questions as possible during the way.
Hi, Cindy. I just noticed there's a question already. Well, someone is asking if we are able to share any of the presentation with PDF version.
Yeah. Yeah. Okay, so two things. One, before we were able to share the material for free with people who were actually attended. However, afterwards, what we noticed that people actually copied our material and circulated around to their group without our knowledge or permission. So that was a bit troublesome. So what we will end up doing is that we actually are recording this whole conversation, including the slides, and we will put everything on YouTube in our channel. So you will have access to the playback and all the slides afterwards. But you can't, like, just like somebody else did, they took our material, rebranded with their own brand. So we just want to prevent that from happening. Is that good enough?
Okay, so far we have 9 attendees, and actually we have more registered. Yeah. So we will just wait for more. Thank you.
Yeah. What time is it now? 7:04. Okay, wait for 1 more minute, then we're gonna start. It's jam-packed, so ask away. Yeah, if you feel it's.
Yeah, I just noticed another question jumped up. Well, yes, that's right. We will give the YouTube link after the meeting directly email to you guys. Thank you.
Yeah, we can, or even we can type in here too, but we'll email as well. Yeah. We have a lot of past material on there, including, you can see like our real projects, real pictures, real videos, real asset sites, things like that. So. Okay. Super good question. Super good question. Can you remind me to do that? Because I want to go through the product first, and then I'm able to share with you our real experience, real numbers, and really what we see on the market on the front line here during COVID-19. but I don't want to talk about it up front. I want to talk about it after we have gone through the products. Can you remind us to do that, please? Okay, there's another question. Minimum investment period. This is gonna depend on product. I'm gonna cover all of it for each product, so you know which one works the best for you. Because some people like short term, some people like long term, and there's a reason why for that, which I'm gonna go through it. Okay. All right, let's start. Another question, yes, there is option dividend or monthly payments depending on the product, okay? Depending on the product. All right, let me just, let me start. Okay, so a bit about who we are. We operate under 2 brands and eventually more later on. So our vision is, and that's what actually we have been very passionate about. We make a difference by helping people achieve financial freedom and time freedom so they can pursue their dreams. Our dream is to help other people achieve what we have achieved so other people can pursue their dreams with money and time. How we do that? We connect you with amazing deals for minimum risk and above average market returns. So we try to bring you the best risk adjusted return for the assets or for the deal. And how we achieve that, the whole purpose to build financial freedom and time freedom is to grow passive income. And we're going to cover how we do that from both short-term, mid-term, and long-term in different products. And also, we want to make sure the passive income actually increases over time. Okay, so the older you get, the less you work, the more money you have. Money grows on trees. All right. Okay. Next one. A bit of a track record. We have about over 1,000 lenders or investors or contributors in our community. We operate under 2 brands. Reality is our asset acquisition brand, and My Lending Space is our debt lending brand. And average people per year contribute about just under 150K per year. These numbers are outdated a little bit because we have gone past these numbers. So total contribution to date, we have been deploying capital over 50 million, and highest single contribution from one instance from one individual is 1.78 million. And we have successfully exited more than 400 projects. Okay, so we do a bunch of things, but essentially everyone who comes to us fall into 3 categories. People who never do anything with us, but they attend all of our training and education. And this way we help that we can spread the knowledge to help you to help you deal with whoever you like to deal with and invest soundly. Another model, which is guided contribution, is a lot of experienced investors. They want to manage the project themselves, but we have a lot of deal flow, so they actually buy projects up from us because we have already vetted the project and everything, all the due diligence done. So people just buy product from us at a discount. Also, the past contribution is the most popular model with our community. We do everything, and you just become a money partner, and we do everything. All you do is sign papers at the comfort of your home, and we're going to cover most of it today. All right. Okay. We talk about our track record, just a little bit about the founders. So all of us have achieved financial freedom and time freedom under 5 years, more specifically in 3 years, by doing exactly the 6 models that I'm going to be covering today. Some people take less, some people take more time. It all depends on your own specific situation, but at least we can tell you what we have been doing that's being successful. So we're all full-time real estate investors. We all made our first million in real estate. We actually invest in the same deals and projects and assets that you see. We send out deal alerts every week or so. Those are the same deals on the same terms and the same asset that we actually ourselves buy as well. And we have invested multi-million in the same deals that you guys have seen. So we are growing with you guys. Okay, so this is the 3 products that I'm going to be covering today. But what I want to draw your attention to is these 6 products. These 6 products fall into 2 categories. On the left here, it's all debt instruments. These are all lending product, okay? The first 3, all lending. Private lending, MIC, legal lending. These are all lending products, okay? The second category is equity product. Conversion, multifamily, flipping. These are all asset products, okay? These are equity products. Do we have questions?
Yes, Cindy, someone just raised a hand and left a new question on panel. And the question is, how are you guys regulated? And what do you mean by investors get to buy at a discount? Okay.
So I'm going to talk about acquisition. When we talk about conversion, multifamily, I'm not going to talk about flipping today because everybody knows what that is. I'm more going to talk about conversion and multifamily. I will allude to that. There are 2 models. You can either buy from us or we manage everything. Okay. The first question was the regulated. Oh yeah. Okay. So on the debt products, we have the right. So how do I explain this? We hold licenses for each of the different products. So we have to get audit every year. We are 100% compliant, all of that stuff. You're gonna see more of the credential when I talk about the individual products. Make sense?
Yeah, I think you can go ahead.
Okay. So let me quickly go through the 6, and then I'm gonna go into details for 5 of them. On the debt product, we have private lending. This is a cash flow product. You are getting payment monthly. So the person who asks about dividend or payment, you're getting a steady cash flow monthly for private lending. Okay, the term is about 12 months or less. So this is a short-term product, and the return typically is between 8 to 13%, depending on the risk and the deal. Okay, and the collateral is a piece of real estate in Ontario. Most likely it's a house in Toronto. All right. MIC is the upgrade of private lending. I will explain the reason why we have to get a MIC to satisfy some of our lenders. So the targeted annual return is 8 or 9% a year. And also this is a cash flow product. You are able to get dividends every month, okay? And there's no time constraint for this one. For MIC, as soon as your money enters the MIC account, you start earning. And if you withdraw the money, then your dividend stops, okay? So you can enter and exit anytime. And the MIC portfolio, just like lending, is a portfolio of real estate assets. So in private lending, if you do it on your own or individually, you're probably only lending to a few houses, whereas MIC, you diversify across tens and thousands of houses, okay? Legal lending, most people haven't heard of this. It's very prevalent in the legal world. Basically, you are getting 10% annually, and all the interest is paid up front. I'm going to explain that a bit more in details. And term is 12 months, you can renew or not. And it's secured by a portfolio of motor vehicle accident plaintiff files in Vancouver. That means the court is going to award the payouts, and you just have to finance the bridge in between. Okay, so that's the lending product. All of these, you just earn a return at the comfort of your home by clicking the DocuSign documents and sign, rename. That's it. All right. conversion, multifamily, flipping, these are all equity products. Okay, these are all equity products. What do I mean by equity? So instead of getting cash flow, what you get is these numbers. What you get is upon exit after number of years, when you annualize your return over the number of years, you are getting what we target is this and more, 15% and more, okay? Conversions, these is, you take a single house and you convert into legal suites. Basically, you can legally rent to 2 or more families. Therefore, your cash flow position improves much stronger, okay? Multifamily, I don't know if you guys have been following us. We've been buying buildings. Basically, multifamily is apartment buildings. It's secured by apartment buildings. And the conversation is very relevant when we are in the middle of the COVID-19 situation. I'm going to share some really interesting real stats, real numbers from our portfolio. And flipping, everybody knows what it is. You buy a discount or distressed properties, and you renovate it, you sell it. Before COVID, we no longer do flipping because the market does not have the margin. However, since COVID, we have seen some opportunities, and that might hit us as well in terms of getting back into flipping. All right. Are there any questions at this point?
Yeah, Cindy, I just noticed another question. Okay, so someone just asked, in MEEC, what's his ratio of investment between first and second mortgages with respect to the total MEEC portfolio? Okay,
very good question. I'm gonna go in more details when we talk about MEEC, but right now, off the top of my head, so second mortgage is about 70 or 80%. First mortgage is about 10 or 20%. Our LTV, total portfolio LTV is under 67% as of now. So super safe, okay? Oh, I shouldn't say super safe. My lawyer's gonna slap me, I guess. If you guys know, if you guys know about the market, and we don't lend a commercial. It's pretty much just residential. So you can compare that LTV. You can compare that LTV to other mix on the market. We don't do development projects. We don't take on that risk. It's pure residential. Okay. Any other questions?
Yeah, I just noticed someone commented in the chat panel. The question is that conversion and multifamily, when you talk about guided investment versus you doing all the work, how is the return impacted and distributed?
Oh, very good question. I'm gonna go specifically about that in each product, because the guided and the passive, the main difference is only in the conversion project. So if you do everything yourself, all the deals we're looking at, we're targeting for you 25% and above. If we manage everything, we're targeting 15% above. That's essentially the difference here. Obviously, if you buy multifamily buildings, same thing, 15, 25, that's the difference.
Excellent. Cindy, I think you can continue now.
Okay. Now, I'm going to talk about this part first, conversion, multifamily, then we go into lending, okay? Okay. The reason why I want to talk about conversion first is because after our last seminar, most people actually, they qualify for conversion. And they're very interested in conversion. So I'm gonna talk about this one first, and I'm gonna share a deal we haven't sent out yet. And I can walk you through the details and the numbers so you understand how this product works, okay? We're gonna talk about what is conversion, where to buy, how, all of that stuff, all right? So what is conversion? We actually started by lending money out, and our money just keeps growing every year. And a lot of our investors and lenders are saying, okay, in addition to fixed rate of interest I'm getting, I also want to hold assets and enjoy appreciation. But where the hell can you hold a house, piece of real estate with positive cash flow in Toronto? It's next to impossible. This is how this product has been developed. And each of us have loaded a lot of our capital into this product as well. So this is a new way we developed to hold asset with positive cash flow, where it's been pretty rarely found in Toronto. The intention of this product is to maintain relatively flat or positive cash flow position while easily holding assets in an area that we think are up and coming. Okay, so what we're doing is we will acquire a single dwelling, single house, which fits a bunch of criteria that we're looking for, which can be converted into legal duplex, triplex, or secondary suites. Okay, the construction takes about 6 or 8 or 12, depending on the situation, for a standard conversion process. The participants will apply for mortgages, and we will do everything from beginning to end. So basically, each product, I'm going to talk about each product. You have to make sure you have the mortgage qualification room, and you have to make sure that you have the minimum capital for each product we're going to look at. I'm going to talk about the capital amounts you're looking at for each product as well. And sorry, yeah. Where was I? Yes. So I'm gonna in following slides, I'm gonna show you the capital you need for every product and the obligations on both parties. Okay. Now, does anybody have questions about the concept? We're simply taking a single house and make it legal, convert it to be able to rent to 2 families in order to preserve cash flow. The concept is very simple, okay? No questions, I'll move on.
Cindy, someone just quickly asked, do you require separate meters for every suite?
Okay, very good question. We see it 50-50. 50 of the project that we do based on the investor preference, they separate it. 50 do not. There's pros and cons for each. It depends on how much management you want to get involved to. For our own project, we always separate, but I mean, some investors, they don't want to, and it doesn't have impact. Any other questions?
Yeah, I think we can go ahead.
Okay, all right. Now, what is the driving force behind conversions? There's something called Bill 140, which is a provincial bill, Strong Communities Through Affordable Housing Act 2011. But, okay, that's why acquisition is super important for conversion, because every municipality has a different view and different sets of laws, bylaws on this. Therefore, you really have to know which part of the city, in which city allows for secondary suites, and what is the compliance code for it, okay? Advantages. Most people say, I can just rent out my basement, I don't care. But when problems happen, you do care. Why? Because it's not so safe just to have a basement, because you can get called on and sued anytime, okay? And after legal conversion, you can usually charge higher rent. Also, this reduces your risk. And when you resell it, usually if it's legal if it's a legal conversion with a certificate, you can sell for a higher resale price. Also, if any of your tenants calls and say, hey, I'm living in an illegal basement, whatever, you're gonna get shut down. So complaints is a big thing, and legal conversion prevents that risk. You're gonna get shut down or fines if you don't do it legally. When you apply for mortgages, if it's not a legal converted property, you most likely will not be able to qualify for as high of LTV as you want. Also, it's properly designed and built, so tenants has more comfort living, and you will be able to attract higher quality tenants. Okay. Where to buy, why, and how? Any questions so far? If not, I'll move on. Okay, our philosophy is we never buy too expensive, but we buy where the needs are there. There's no speculation. So you see how in the middle here, Toronto, the density of population here is significant. So where do people move? Where has the population been flowing to? To the east is Durham. To the west is Hamilton. Okay, so where we buy? Based on our unique model and based on our threshold of 15% or 25%-ish return, we buy where people go. So we tend to buy just around that 500K mark in the next up and coming area so that we can still hit our thresholds and make the return. So for example, I'm gonna talk about that later. I will tell you how we have eventually moved through cities because the prices have gone up. All right, so somebody asked about the capital amount, minimum investment, whatever, right? For conversion projects, if you do conversion in downtown you typically do duplex or triplex in Little Italy, Little Portugal, etc. in those areas. You are required to have about 700K to 1 mil cash, okay, on top of the mortgages. All right. We heavily do in Durham because it requires smaller upfront and has the most appreciation potential and highest expected ROI, closest to Toronto. Notice how I said that? We are looking for that balance. We're looking for that balance. We're looking for what's the best risk-adjusted ROI closest to Toronto. Any questions here? And the capital upfront needed is about 200 to 300K per project here. And you can get about 30 to 40% back in the first year after refinance. Any questions here? And same thing, we used to do a lot in Hamilton. With the price going, now we're doing a lot in Brantford. Same thing, we used to do Ajax, Pickering. Now Oshawa is the sweet spot. So right now, Brantford on the west and Oshawa on the east is a sweet spot for the model and for the numbers to work. Any questions here? If not, I'll move on. Okay, I talked about this. People with higher capital capability, also they're eyeing for downtown as well, which we do as well. Okay. How come I see lots in the chat? Do we have? Okay, never mind. There's nothing.
Cindy, you can just click more and stick that chat panel to your window while you go through.
All right, cool. Okay, so a bit more on the area here. That's right, I hadn't talked about this. Okay, why we picked Durham and Hamilton and these two areas? See how Toronto here? That's all red, right? That's intensity of people, right? Move, where do people flow? On one side, this is Lake Ontario. On the other side, we have the biggest green belt in the world, okay? This is the whole Golden Horseshoe area, which we're focusing on. That's why we track where people move, and that's where we invest, all right? So there's land scarcity, there's transportation, there's return, etc. That's given. Okay, specific on Durham, because we do a lot in Durham right now. Just some key points. First of all, I don't know if people know about this area, but it's basically only 15 to 30-minute ride from Toronto downtown, okay? We are actually witnessing a rise of a satellite city outside Toronto, and it's gonna go, and I think it's gonna come pretty fast. It's expected by 2021, only less than 2 years from today. The population will reach 750K, and next milestone is 1 million. GO Train it's already extending to Bowmanville. All right. I actually noticed a lot of investors are moving from even Oshawa to Bowmanville because Oshawa is growing as well. The GO station is huge along 401. So if you take a look at Pickering, Ajax, Whitby, Oshawa, etc., it's packed. 5-level parking compound, it's packed. All right. So people start to really live in Durham and work in downtown. I mean, before COVID. Now there's a bunch of really big companies which have invested significantly in Durham in the past like 5-10 years. Most noticeably, the casino, the new casino that's already broken ground and supposed to be in operation. They are adding 30,000 jobs, which it's about adding about 100K, 100,000 people in Durham region alone. Okay, think about that. Other one is most people are saying, oh, I love to hear this when people say this, oh, there's nuclear plants. You know, when people still have that impression, that means people haven't realized the investable potential there yet. So I don't know if the government has published that, but internal document shows the nuclear plant, it's going to shut down by 2024, and the nuclear waste is all going to be done by 2028. All right. After this, right. So I want to show you. So we talk about nuclear. We talk about the casino. There's also, I didn't really put on here, but there's been many years of the proposed plan to have an airport bigger than Pearson in Durham. It's the private sector. The funding is there. It's really the government process that's still going on right there. And by the way, the casino entertainment district is supposed to be bigger than Niagara Falls. Specific on transportation, 407 extended, four new GO station between Oshawa, Clarington. This is what I want to show you. Okay, there's Oshawa Center, there's all the big development, that's fine, but this is what I want to show you. I remember how I was talking about, we did a lot in Hamilton and the price went up, everybody got profit, and for our numbers to work, now we have moved to Brantford. Exact same thing happening in Durham. Okay, Pickering, great, it went up. Numbers don't work anymore. Ajax, great, made money. Numbers went up. Numbers don't work anymore. Whitby, same story. Oshawa is the next sweet spot. And as I mentioned, lots of people actually are buying in Bowmanville. All right. Questions here? If not, I'll move on.
Cindy, there's another question just waiting in the line. And the question is that, can we normally get financing or lending for the renovation cost for the conversion project?
Really good question. So typically what we always advise is have that 300K ready. That includes all the renovation costs. Because once you go through that process in 6 or 8 or 12 months, you're able to refinance at the bank and pull almost all of your construction costs out. We're gonna see some real numbers afterwards. So basically that renovation cost, you will able to get back most of it within 12 months. So that's the safest way to do it. If you don't have that, as you know, we also do private lending, so we actually lend on those too. But there's costs associated with it, so that may reduce your return. But if that's the model that you go with it, then that's the model you go with it, right? Any other questions? Okay. Specific tactics in investing in Durham. So we don't speculate. We only target houses that's about 500K mark in good neighborhoods. And because of the spillover effect, so Pickering, Ajax, Oshawa, Whitby comes before Oshawa. These are the pockets that we look at And right now, Oshawa is the sweet spot, and there's no speculation. So this is very interesting. Before COVID hit, because we were buying for ourselves and for our investors a lot. Before COVID hits, we got into a lot of bidding wars. Obviously, we have to stick our budget. We got in a lot of bidding wars. And increasingly, I'm finding investors from Toronto are coming to Oshawa. Many, many times, I'm bidding against investors I know from Toronto, because there is nowhere else you get the bang for the buck anymore. So that's why it's up and coming. All right. Okay, business model. What we do is what we call forced appreciation. Okay, we do the value add approach. You first of all purchase suitable properties owning in specific areas, and then obviously you have to get the mortgage, and then you have to get the permit, you have to design, you have to get the draft, you have to do the construction, you have to finish everything, you have to get the inspection done, you have to get certificates, you rent, you refinance, you hold it, then you keep refinancing, you get your money out, or you sell it 5 years down the road, or every few years. Take the money, buy another one, take the money, buy another one. Always double your money in a couple years. Does that make sense? The reason why we're able to refinance most of the construction costs out is because by doing this approach, we have increased the value of this asset. Therefore, it's a forced appreciation, okay? Any questions at this point? If not, I'll move on.
Hi, Cindy. I think there's another question just to jump up.
Okay.
Someone just asking in the chat panel, do you also help rent it out and property manage?
Okay. If we manage it, we do it from the beginning to the end. We acquire, we do the acquisition, we send you all the papers, you just have to sign, you apply for mortgages, we get the permit, we get the drawing, we get the construction done, we help with refinance, we rent, we property management, we do property management, we sell, we do everything for all the years. Like we do everything. So that's our model. Yeah. So any questions?
Yeah, I think this just to be answered.
Okay, good. All right. So this is just to show you the power of one. And this is all how we got started. Like we started one, and then we keep pulling money out, increase the value, pulling money out, we buy another one, keep pulling money out, we buy another one. This is how you get passive income. When you sleep, your portfolio grows. All right, and eventually you can sell half of it, or you don't sell, or you keep buying buildings, etc. So, that's just a typical. That basically everything you can double, triple, quadruple your portfolio, all starting from that one purchase in the beginning. All right. Any questions? Not a move on. Okay. So just some tips. This applies to multifamily as well. We recommend renovating the most bang for the buck areas. So these are kitchens, bathroom, floor paint. Always use durable and economic materials to generate premium quality design for renters, but do not do luxury, okay? Your ROI would cry. All right. So, and these are typical pictures of the standards of our renovation. If you want to do yourself, this is what you may want to target for. Okay, so as I mentioned, the really key thing is you have to know which ones you can buy, right? Because we vet so many deals a year, and 1 out of 10 we will bid on, because 9 out of 10 do not qualify for conversion, right? You have to know the building code, you have to know the fire code, you have to know you have to know all the codes, you have to know municipal bylaw, and you have to know where you can get the variance and where you can get by, right? Because sometimes it conflicts with provincial codes. All right, so like zoning, parking, ceiling highlight, square footage, how many, what's the egress, how many rooms can you fit, design, acoustic, heating, cooling, plumbing, all that stuff. You have to know it. Otherwise you buy wrong. If you buy wrong, you're dead. All right, the process, bylaw, then you get a permit, like floor plans, elevation, sections, details, construction specs. Now, we never have to go to committee of adjustments because we know what to buy, right? If you don't know, it's going to be a big problem. Everything afterwards, renovation, construction, inspection, final approval, refinance, rented out, hold it, property management, all of that stuff. Okay. So I wonder if okay, I'll quickly talk through this and I'll show you a real example. All right. So on the left is it's a single family, which we're all very familiar with. Okay, ignore the price because these are from a couple years ago. There's no way we get these except for in Brantford right now and definitely not in Oshawa. All right. Okay, so single family, you don't do any conversion. Purchase price this much, down payment this much, okay? Cash flow you get, you rent out for one single family, you know, this is what you look at. Now, why do you have to add additional suites? Why do you wanna do legal conversion? If you legally convert this, purchase price, down pay, renovation, say 60. Now, afterwards, your rent will go up significantly. These are no longer correct. We are able to get at least 3,500 per month, but that I can show you the number afterwards, right? And mortgage refi. See, your cash flow grows significantly, your property value grows significantly, and your ROI is much better than this one, whereas you can pull most of this money out. So the money you left in here is essentially very close to 88. That means, what does that mean? That means after you've done that much work, you're left with a much improved building with higher cash flow, with higher property value, with higher ROI, but essentially you have essentially the same amount of money left in the building. So you bought a much better thing with the same money. Essentially, that's what it is. So why not do it if you can, right? Any questions? So the key thing here is the first refinance allows most of the construction money to be paid back. That means the asset value has increased, but the money tied into property is essentially the same, right? So before conversion, your cash flow is okay. Natural appreciation is okay. Resale value is okay. After conversion, your cash flow grows significantly. Your natural appreciation is higher because your house starting point is worth a lot more money than what you had. Your resale value is also higher, okay? If there's no more questions, I'm gonna show you.
Hi, Cindy, there's another question.
Okay.
Is the ROI cash on cash of 88 plus 66 or cash on cash of 88?
88. I will show you. That's a very good segue for my real numbers. I'm gonna show you for one conversion opportunity that we haven't sent out. We're gonna send out tomorrow. Okay. So let me walk through the numbers. Any other questions before I do that?
No, I think you can go ahead.
Perfect. Okay. So I'm gonna show you. This is a real deal. We're gonna send it out tomorrow. How do I maximize this? I'm assuming you can see clearly, right? Okay. So this is a Oshawa house in this is a 3 bed, 2 bath bungalow. It's located in an A neighborhood. Sorry, spelling mistakes. It's located in an A neighborhood in Oshawa. This, we already vetted it. It can be converted into 3+3, meaning 3 bedroom upstairs, 3 bedroom downstairs. So 6 beds, 2 baths in total. Okay. So you will have two legal suites, and the lot is quite spacious, 57 times 103. Okay. According to our model, the acquisition price is about 490 up to about 500. There's a bunch of improvements, etc. Now, I'm going to show you the numbers so you know like how much the renovation is going to cost on this one. So based on our experience in the same neighborhood, After conversion, we are estimating the ARV, the after repair value will be around 600 to 630K, and that's a pretty conservative approach. We have seen some 670 and 710 before COVID, but we've been very conservative with COVID. And based on our experience in this area, upper floor, lower floor, we're conservatively getting 3,200 per month. We're already getting more for our other assets, but I mean, we're just being very conservative here. So 3,200 rental income per month. I'm going to show you the numbers and cash flow later. Based on our experience in this area, once this asset is acquired, there is no impact on the construction and the permits so far, based on our experience in this area, okay? And the whole project will be completed, if we do it, probably like 3-6 months-ish. But I have seen some people doing 12 months, so to be conservative, 6 to 12 months, you're looking at your first refi. All right. Okay, here is, somebody asked about the 2 different models and 2 different returns, right? 2 options. One, the investor qualifies for a mortgage, and we manage everything from beginning, from acquisition all the way to exit, to sell, okay? We manage everything, you just sign papers. The estimated ROI after exit, let's say we hold it for 5 years, we estimate it, target about 15% annually, if you annualize it retrospective. If the other option is you qualify for mortgages and you manage everything by yourself, you simply buy it from us, then the estimated ROI, once you exit, say 5 years, is about, based on our model, is about 25%. Okay, so that's 15 and 25 is what we target for this type of products all the time. All right, it has to fit that number. All right, property highlights is gonna, so this one can be converted into a 3+3, relatively big lot in a well-established neighborhood, parks, golf, highway access. Driveway is quite large, so sometimes we actually have to mushroom the driveway in order to comply with the bylaw, but this time it's good. We don't have to do anything about it. The entrance is already separate. We don't have to never do underpinning in this in conversion projects. It's gonna blow your budget. So estimated monthly income, to be honest, 3,200 is pretty conservative. I would say 3,500, but you know, to be conservative, 3,200. And acquisition is around 490, 500. Estimated short term, so on day one, your renovation holding cost plus your down pay everything, it's estimated to be about 250K. After first refinance, within the first year, you're able to pull out about 110. So you have about 150 left in this asset after conversion, after the first year. So your ROI upon 5-year exit, if you operate it independently, if you do everything yourself, about 25 plus. If we do everything for you, about 15 plus. The market, we went through it. Basically, a few things we look for: strong population growth, strong population growth, vacancy rate, and renter demographics. So, you know, we haven't had too much problem there. Average rent, conservative. Yeah. Okay, so let me show you. If not questions, I will proceed to show you. I just want to give you a visual. This is one of the other project we just finished in the neighborhood. Before, it looks like this. Oh, what did I do? Before, it looks like this. Right? You just have to, you really have to gut everything. You have to gut everything. All right? After, it's like this. This is actually, we got really lucky on this one. it's rare to find a super large lots. And typically we only do we only convert to 3+2 because of layout and land. But this one, we're able to get under 500K for 4+4. So we fit 8 bedroom in this bungalow. And it actually looks very spacious and everything's very open. Right, so that's the sort of standards that we do. Depends on the asset, I guess. Okay.
Hi, Cindy. I think we have received more questions on the chat panel. Okay, so first one, is there any particular reason now to hold longer than 5 years? Would the ROI numbers still make sense beyond 5 years?
Oh my God, this is such a good question. Okay, I tell you guys hold 5 years because every time an investor asks me, I always have to give them the answer. But you know what I do for my own property? I actually hold it much longer. I actually don't sell. I just keep refinancing because the more I refinance, maybe I should just, because the more I refinance, the more I refinance, the better ROI I have. Because after I refinance, I repeatedly refinance, guess what happens? I get all my money back. So I have $0 left in the house and I still own the house and I still own the cash flow and I can still refinance as ATM. So personally, I don't sell, but some investors are like, well, you have to tell me, right? Like what time horizon? So I typically tell people, okay, like 5 years. But this is completely up to the individual. Some people sell earlier, some people sell later, but for me, I always hold.
So yes, people agree. But the other question is that they would prefer to hold forever. So in that case, would your property management forever, or you only do 5 years?
No. We will do forever because after your principal is being paid back, every time we have cash flow, or every time we have cash flow, or every time we have refinance back, we're doing the profit share. So we get paid after your principal is paid back, and we manage it and we get paid.
Yeah. So that comes to another question. You said it's going to be paid with dividends, right? So when we partner with, when investor partner with us, who will be on title of the property?
Very good question. Who's going to apply for mortgage? Think about that. The investor is going to apply for mortgage. Therefore, the investor is going to hold title. We're going to have a agreement, a shareholder agreement. So essentially, the investor is going to be on title.
Yeah. So another question would be, once principal is paid off, profit sharing on cash flow, what's the split? Oh,
very good question. We typically, on the market, most people do 50-50. We typically do like 50, 55, 60. All depends on the actual asset. So this is a very good question. Great segue into the number I'm going to show you, right? So this particular asset I just talked about, okay, this is our analyzer. So if we're doing split, we're doing 60-40 here. Why? Because after the investor gets 60, then you hit the 15%. Like here, we forecast about 16% for the investor, right? So purchase price, if you look at here, purchase price, your loan amount, your down pay, reserve fund, your closing costs, renovation, we're talking about 130-ish for this particular one. Estimated repair value, you're looking at also refinance 80%. We just take a regular 2.5 right here. So you're looking at $250,000 upfront and about 150 left in the house after we stabilize. We have monthly expense, rent, everything, operating cost. You're looking at mild cash flow. You can decrease your LTV, you can borrow less money, increase this, all depends on you, right? So this is a scenario we typically rely on. So 5% annual appreciation. Just so you know, since 80, it's about 5.5 for Canadian real estate. So we took 5 as a appreciation. Then we know what's outstanding mortgage. We know what's the estimated sale value upon year 5 or after stabilizing. We know how much equity is left in there. We know what's the cash flow, total return, etc. And after split, for this particular one, it's going to be 40-60. Investor gets 60, then you're looking at about 16%.
Okay, so another question would be, is the ROI annualized or over the 5 years total?
No. If it's over 5 year total, we'd buy Canadian bond. No, it's annualized. Okay, annualized. Yeah, because we're always targeting annual. We're always targeting doubling the money every few years. So like, you can see why we succeed and become popular among investors, because we always try to get people double-digit returns every year, right?
There comes to another question. Someone just asked on the Q&A panel, what will be the cost of renovation for this Oshawa property?
Right, okay. Just like I said, look at here. How much we buy, blah, blah, blah. Okay, renovation holding costs about 127,000. Okay, so you're looking at initial, your down pay plus closing costs plus reserve fund plus renovation holding costs. You're looking at just under $250,000. All right, and this one, so we did two scenarios. One is, we manage everything, so 6-4 split. The other one is you buy it from us, basically based on our model. If we don't do anything, you just do everything yourself. You don't have to do profit split. You're looking at like 25 plus, like 27% if you sell in 5 years, estimated. Okay. So that's why we always like, if we manage it, we're targeting 15% and up for investors. If you are managing yourself, we're targeting 25%. We're targeting 25% and up. All right. Any other questions? If not,
sorry, I just saw another jumped up. Okay, so here's the question. If investors' money is tied up in the properties, is it possible to refinance purely based on the value and the rental income of the property?
Can you repeat that again?
Yeah. If investors' money is tied up in the property, is it possible to refinance purely based on the value and the rental income of the property?
Okay, I'm not sure. So I need to ask more about this question. I'm not sure what. Okay, let me try to understand and try to answer it. So you see how here you're putting about $250,000 to stabilize to do this project. Within 12 months, you should have completed it, and you should go to the bank and refinance out $112K here. Okay, then your money left in the building in the asset is about $150. Okay, so you are getting $110 back within 12 months. All right, is that what's being asked?
Yep, I don't think another question just jump up. So yeah, I think we can continue. If there's some other question, we can open the FNQ at the very end to answer all the questions.
Great. Okay, so you addressed all the questions, right?
Yeah.
Okay, that's great. Okay. Right. So that's the first product. I swear, I'm gonna go faster because once you get the concept, it's easier. I'll just leave it here. Okay. Next product we're gonna talk about is multifamily. Actually, it's almost the same concept, but a bit more technical. Also very popular. We put a lot of our money into multifamily because it has some really distinct advantages. Great to know. Okay, what is multifamily? Okay, the easiest way I explain to people is it's an old apartment building. All right, it's typically with 4 units and up, but we actually buy 8 units and up because 4 sometimes you can fall into residential. You can still go to the big 4 to qualify, etc. All right. So it's simply apartment buildings. Before I go into details, I want to introduce a very important concept, cap rate. Do I need to explain the cap rate, or does everybody know what a cap rate is and why we have to know about cap rate for commercial or multifamily buildings? Shirley, do you have any feedback?
Yeah, I noticed someone typed that they are aware of cap rate already. So, well, you can briefly summarize just in case someone doesn't know.
All right. Okay. You guys know how like we're talking about conversion, we talk about like houses, condos, whatever, residential. You know how in the market, how we buy them, how we evaluate what's the valuation of those is by comparable analysis. Basically, if I buy a house or if I sell a house, I just have to see, okay, in my neighborhood, what's my neighbor selling for? What's the same size of house or same layout? How much do they sell for, right? That's a comparable approach. Whereas cap rate applies more in the commercial real estate evaluation. Why do we talk about commercial? Because anything with 4, 6, or whatever units up is classified as commercial, even though multifamily is commercial residential, meaning it's still for residential purposes, but for mortgages and for zoning purposes, it's classified as commercial. Okay. Now, how do we evaluate? How do we determine the price of commercial properties? It's through cap rate. That's how bank, that's how seller, that's how buyer determine the value of commercial buildings. Okay. What is cap rate? Cap rate is simply your NOI, so your net operating income divided by your property value, or in other words, how much is this building worth is equal to your net operating income divided by cap rate. Does that make sense? So for example, Toronto cap rate is horrendous, less than 3, okay? 2 point something, all right? Let's say the cap rate is 2%. If a Toronto building, oh, by the way, sorry, another concept I didn't explain very well. NOI, net operating income, has to exclude financing costs because you cannot compare apples to oranges. Therefore, your net operating income excluding which excludes mortgages. Let's say it's 100K a year. Okay, if it's 100K a year, if your NOI is 100K a year, your revenue is 100K a year. If your cap rate is 2%, you use 100K divided by 2%. That is how much this building is worth theoretically. Okay, does that make sense? Okay, here's some examples. All right, here's a simple example. If a building has 100 units, do I want to talk about this now?
Cindy, I think there's another quick question.
Yeah.
Would you like to answer that before?
Sure.
Yeah. Okay. Yeah. So they're just wondering, why don't you invest in Class B multifamilies?
Where does, okay, where did you get the concept that we do not invest in Class B multifamily assets? Because we do. We buy A buildings and we buy B buildings too.
Yeah, I think they misunderstand on the slide. It says say rate, so they were a little bit confused.
What rate?
Cap rate.
Cap rate. No, yeah. It's cap rate.
Yeah.
Yeah. All right. Okay. So let me give you. I'm thinking, how do I explain this? Okay. Let me talk about this and then jump back to this because it's gonna help. Okay. In many of the areas, the bank's appraisal use cap rate of 5%. Okay. Now, do you see why cash flow is so important for multifamily? Because if the cap rate, for example, is 5%, for every dollar you increase your NOI, your net operating income, you will increase $20, 1 divided by 5%, $20 in your building value. That's a 20-fold increase relative to cash flow, right? Your cap rate amplifies your increasing building value. So if we go back here, say for example, if a building has 100 units, if we increase each unit rent by $30 a month, the building's annual rental income will be increased by 30 times 100 times 12 months, that's 3,600, right? If we lower the cost of each unit by 20 per month, and by the way, increase rent and decrease, increase rent per unit and decrease rent per unit is what we do on every building, okay? Then the annual operating cost will be decreased by 24,000. We use 36,000, add 24,000 is 60,000, right? That's our savings plus our increasing rent. So we actually get 60,000 more in our NOI, correct? Okay. Now, assuming if the cap rate is 5%, how much did the building go up in value by us increasing rent and lowering cost, which, by the way, is the essence of forced appreciation? The building value will increase by 60,000 divided by 5%. It's 1.2 million, okay, based on previous year's NOI, right? Any questions?
Which means this assuming there's no an increase of the rent, right, Cindy?
No, we increase rent by 30% a month.
I see.
Yeah. Okay.
Yeah, I think you can go ahead.
Great. Okay. That's why I want to introduce this concept before I go into the details. So you know why it's important to increase cash flow in multifamily and why cap rate is important, okay? Why choose multifamily? We did lending, as I mentioned, we started lending. Eventually we want to own assets long-term, so we had conversion. And then we move on to multifamily. Why? Because we can profit from multiple streams of income. Appreciation, we have forced appreciation. We have equity we can leverage. Qualifying for multifamily buildings at a bank is very different than qualifying for residential mortgage, because income no longer matters. You are no longer capped. Once you have a commercial portfolio with the bank, you can buy forever, infinitely, okay? I mean, it's tricky to do that, but it's possible. It's not so possible with residential, but for multifamily, if you do right, if you know what to do, the bank will lend you money, all right? You get cash flow much more than holding single houses. You got mortgage pay down much faster. You got tax advantages. You also get future opportunities advantages because, so for example, a lot of buildings we buy, we actually look at the lot size and see how we can increase density. Sometimes we have a winter building right across from a lake, which the parking lot, we can fit another 2 buildings on them in the future, okay? So we're also looking for development opportunities when buying buildings, okay? Also, you can also, a lot of people say, oh, it's too expensive in multifamily buildings, which I'm gonna walk you through the numbers. A lot of times we put several people together. So each of us will buy a sharing a building, and we all own the building through the investment corporation. Okay, so you essentially can syndicate to buy a multifamily. All right. Okay, I talk about this. We're also buying multifamily buildings, not in Toronto, but in the next best spot. We bought a lot in Hamilton. We bought in Durham as well, and we're continue looking for good deals. All right, and I'm not gonna go into the location details because we just went through that. Okay, what's a strategy? This is very important. The concept is the same. You buy the building. Half of our time we buy privately, half of the time we buy publicly. Okay, we also have a good deal pipeline on private deals. We buy. Sometimes we prefer the shittiest building on the street. The shittier, the better, because we know our shit, so we can add tons of value, okay? Again, we renovate, we add value, we evict. Eviction in multifamily is very different than eviction in your single family. So that's an art more than the science too. We were on National Post and on a bunch of newspaper for sometimes. I'm telling you, eviction is quite a story. And then we renovate. We remove the old tenants, we renovate, we put new tenants in, charge a much higher rent, refinance at the bank, keep repeating the process, keep refinancing, keep getting the money out, keep refinancing, and we just repeat the process. Okay, that's it. Make sense?
Cindy, I just saw another quick question about the cap rate that we just talked about.
Yeah.
They're just wondering what's a cap rate in Durham region right now?
Oh my God, I can go on days for this, okay? I'm gonna talk about the COVID thing at the end because I'm gonna touch upon a bunch of stats that's firsthand information across all different product types. So here I'm gonna specifically talk about pre-COVID, okay? Pre-COVID, if you buy market, you're looking at close to 4 in Durham, close to 4 in Durham. Appraisal-wise at the bank, you're looking at close to 5.4 or 5.5 at the bank. So a lot of people can't wrap their head around how can I buy at a market value at 4 or 3 something, and then the bank only appraised me for 5 or 5.5 or something. But that's just how the banks function in those areas today, both in Durham and in Houghton. All right, so that's pre-COVID. That is what's happening on the market. Does that make sense? Those are the cap rate that we also send out reports and the stats as well on cap rate because that's something we monitor very closely. Any other questions?
Yeah, I think you answered it and you can go ahead. Thank you.
Now, this is the interesting slide I want to talk about. Okay, so as I mentioned, when you acquire for conversion, it's key for you to know what you buy, even more so for multifamily. Okay, we have a laundry list of key criteria, but here are the most significant ones, okay? That's why we vet a lot of deals every year. We only vet a few. Okay, first of all, we are looking for deals we can do significant value add. What does that mean? First of all, I want to look for the rents, the current rents, which is way below market rents, right? Because typically the building's shit. Typically the renters haven't paid for a long time, or they're getting like 800, 900 per month, which is way below market rent, okay? So that way, I know there's a lot of room to add value and increase appreciation for the building, all right? Secondly, is there room for conversion? Meaning, we can usually take a look and measure the size and figure out whether we can convert a bachelor into one bedroom into two bedroom into three bedroom, etc. Later, I'm going to show you an example where we converted an entire building from 1 bedroom to 2 bedroom. Okay, and the rent increase is significant if we can do conversion. All right. Third thing is obviously renovation. Like we have to do significant renovation in order to force the value up. Okay, so essentially, is there a significant room for value at lower market rent? Also, house and management. Is the management really bad? The worse, the better for us, because we can buy low, and our expertise is in turning the building around, increase its value significantly. That's why we like to buy the shittiest one on the street. Can the conversion be guaranteed? Can we, without, sometimes we can even convert without getting permit. It all depends on the layout. So can we do conversion right away? Also, can we reach positive cash flow for the building? Okay. Also, is the building in the location that we want? And how close is it along the new transit lines? And we don't even factor in the rent increase by being close to new transit lines, because that's just icing on the sugar. And finally, after we vet everything like tenants, location, cash flow, bylaws, discounted price, after layouts, rents, after we underwrite everything, in the end, is the return hitting our 15 or 25%? Okay, so it's a laundry list. Any questions? Okay, we talk about this same concept as conversion. With one initial investment, we keep refinancing out, pulling the money out, put the money in another building, just keep buying buildings. Eventually, you're going to own buildings where you have no money in there. $0, you bought a building. Okay. Same thing, our real pictures, the standard of our renovation. Okay. Any questions before I go into typical multifamily structure? Okay. Same thing as conversion. 2 ways. One, you can supply the money and be the money partner, and we manage everything, including eviction. Eviction is the point I got asked the most typically, so I just say it outright. Yes, including eviction. The second model is you do everything, you just buy the building from us up front, okay? So, which is easy. So I'm gonna talk about more about the JV model. So money partner, in this case, who's gonna be on title? Yeah, so these are the most frequently asked questions I laid out here, so we can talk through these points. So, title on the property, we got asked a lot. Unlike conversion where it's single house, right? Like it's, people usually use their natural name to be on title or holding company, whatever. On multifamily, it's recommended, it's held through, okay, no, let me backtrack a little bit. You definitely do not want to hold a multifamily building under your natural personal name. You always want to hold it on a corporation. Before this year, when we were still small, we always set up an investment co, the holding company, to hold the specific building or buildings, and all the investors, including us, are shareholders in that company which holds the asset, okay? From this year and on, we are actually at a scale we can set up GP-LP structure. So we're the GP and the LP just contribute the money, and the asset co holds the GP-LP structure holds the assets. This way, you don't have to pay tax, as GP-LP is a tax flow through vehicle, all right? So that takes care of the title on property. Any questions? Just ask, all right? Contribution is, again, like conversion, the money partner supplies the money, and the GP does everything from acquisition to eviction to renovation to construction to holding to property management, etc. Everything until exit, okay? Let's hold, again, I do not sell my buildings. I typically, when investor ask, I tell them 5 years, but I typically don't sell my buildings. But sometimes when the building is syndicated, 70% of people want to sell. When the time comes, then we sell, right? Okay, so refinance. Another point I want to mention here is upon sale or refinance, all initial capital contributions paid to investors first. Management company get paid last. Management company only gets paid when the investor gets all their capital back, okay? After investor get all their capital back, profit split happens, all right? And typically it's like, in this structure, depending on the building size because of economic scale. So small buildings, 50-50, 55-45. Sometimes huge buildings, it could go up to 70-30, but it's pretty rare. Any questions? If not, I will move on.
Hi, Cindy. There's another question. Someone just asked, in the LP or GP, if we invest individually as LP, would cash flow distributed as income or dividends?
Super good question. Yes, sorry, I forgot to put it here. When you get your refinance lump sum money before you get all your capital paid back, it's your capital, it's your initial investment, it's capital. It's like a shareholder loan, therefore you don't claim it. It's not dividend, no interest income. It's only after you get all your money back, then you start getting profit, then it's dividend. Any other questions? Oh, and another thing I want to mention, when we talk about I mentioned this before, but I also want to emphasize it again. When we talk about return per year, we're not distributing cash, we're distributing lump sum, because as I said, we only get money when we refinance. Refinance happens every few years. The first refinance happens fast. Like for buildings, it happens within 2 years. For conversion, it happens within 12 months, 1 year. afterwards, you refinance every 2-3 years. So when we talk about average return, like 15% or 25%, it's when you get all your money back and profit back when you sell the building or when you sell the house, then you average over the number of years, then that's the number we target, okay? So you're getting, on the equity product, like the conversion and the multifamily, you are getting lump sum every few years. That's how it works, okay? Any other question?
Yeah, I think you answered perfectly. Thank you.
Okay. Real case studies. I'm gonna quickly go through these as we're, yeah. Okay, so this is a building we bought, 8 units in Hamilton. This is a building we were able to convert every single room into 2 bedrooms, and we got the permit and everything. That's essentially the real numbers that you can take a look. Okay, and this one, so for every deal, we have a sheet that we're going to share with investors and money partners. And this one is 50-50 split, and we're estimating about 70%. By the way, this purchase price, don't even dream it today. You went way up, okay? There's no way we can purchase at this price anymore. All right. You can see how it's done. Pretty distressed. Okay, this building is very interesting. This is we got on national. This is another project. We got on National Post. We got on a local newspaper about 5 times. We evicted everybody under 92 days. 14 units. We've successfully got a permit for 16 units. So we literally added 4 units to this building. So before it's legally 12, now it's 16. We are gutting the whole thing, and we're all almost like developing this whole building. Okay, I think the ARV is going to be significantly higher than what we forecasted as well. We were on a lot of media. We got this 90 per door. Whereas in Hamilton, a stabilized building costs about 200 to $250,000 per door. We got it for 90 per door. Obviously not stabilized. Okay. And we're focusing after split, investors about 20. Honestly, don't look at the numbers too specifically. We always say 15 plus. It's, 15 plus is what we target, and anything above that is icing on sugar. This one is a 6-unit building. Purchased April 18. At that time, we were forecasting. So we purchased for 875. Don't even think about this number in today's time, even during COVID-19. It's not gonna happen. All right. So we did a bunch of stuff. Phase 1, phase 2. Boiler, 2 units, add 1 laundry, etc. What I want to direct your attention to is we actually estimated, let me just, where is that? Where? So valuation, yeah, I should based on PML. We initially estimated I don't even think it's 1.3. This is revised. We initially estimated, if I remember correctly, about 1.2. We actually refinanced during COVID-19, and we got 1.3. We got more than 1.3. Initially, I think we did about 1.2 forecasted. During COVID-19, we financed higher than 1.3. Okay, so our ROI is actually higher in this one. What I want to direct your attention to is here. This is all at purchase. This is our forecast. This is current. So you realize how we're pretty conservative in our forecast, like 1,300 and 1,300. We were able to get actually more than 1,500, more than 1,500. And this one is 1,400, okay? It looks like we actually own half the streets. Even the building beside it, we own. Yeah, we own. So these are some of the finished products. Okay, that is multifamily. Any questions?
Yeah, Cindy, I think you can go ahead.
Okay, great. I'm gonna quickly talk about debts. The three product. Then I'm gonna talk about COVID-19. I'm gonna share some like real hand stats, and then we can first hand stats, and then we can go into Q&A. Right? Okay, private lending. Why do people do private lending? For me, I don't want to just earn.
Sorry, Cindy.
Yeah.
Sorry to interrupt. I just saw another question on the chat panel. Can you have a look? Yeah. So the question basically is, do we find ourselves or you do for the group LPs or multifamilies?
Sorry?
For the group LPs, do we find ourselves or you do? From the investor. Syndication.
Syndication, okay. Typically, I find the investors, but a lot of my investors bring their friends too. But it all comes to me.
Yeah.
What is that the question? Did
yes.
they answer that?
Can you quickly have a look of the chat panel as well? So
okay.
Just in case, because it's just, yeah.
Oh. Okay. Did I answer all the questions?
Yes, that's right.
Okay, then that's fine.
Thank you.
Okay, lending. Sorry, for people who are on the call, does everybody know about private lending? Do I have to go through it? Or is there anybody new that I will go through it?
Cindy, I think you can quickly go through some key features of private lending, because most of our participants, I recognize their name, and they have done tons of deals with us. Yeah.
Okay, fine. Okay, I'll quickly go through it because it is how we started, by earning money, by doubling our money every few years by sitting at home, essentially, right? Why do I want a private mortgage? Because I don't want to earn 1% or even less in the bank, right? I get a monthly payment. Profit is predictable. The most important thing is I can touch and feel my collateral, right? It's backed by a real asset, right? Very little effort required. I only have to sign papers. Okay, first mortgage, second mortgage. First mortgage is the minimum risk. Second mortgage has a bit higher risk than the first mortgage. Third mortgage has a bit higher risk than the second mortgage, etc. Understandable, because the rank. Okay, loan to value is very key. As I mentioned, we are very conservative. So you rarely see like we used to have 85 and 90 deals, extremely high yield. We scaled that down. We turned down all of those deals. Now, like at most we do like 81, 82, but typically we do 65 and under, like 55, 65 LTV. LTV is essentially loan to value, right? So for example, if it's 500K property, if you have a 300K first mortgage, you have a 100K second mortgage, you use 300K you add 100K, your debt on the property is 400K out of the 500K, which is the worth of the property. Therefore, use 400 divided by 500K, that's 80% loan to value, right? So the higher the loan to value, the higher the LTV, the riskier. The lower the LTV, the better. But of course, you have to look at the whole deal, right? Location, house value, who are the owner, etc. Right? Okay, interest payment. Any questions so far?
Hi, Cindy. I just noticed someone left another message about private lendings.
Yeah.
They would like to know, first of all, they want to know legal lendings and make more.
Oh.
Secondly, not quite family, also promissory note. Normally even higher return, but shorter term, around 10 to 15%.
Okay.
Do we do those?
Okay. Very, very good question. Where is the, okay, got it. Okay, got it. What's promissory? Okay, got it. Okay. You know what? If everybody knows about private lending, can I go directly into MIC and into legal lending?
Yeah, I do think so.
Okay, great. Perfect. That's even better. Okay, can I go legal lending first? Because legal lending is probably something that legal lending is probably, you know, most people don't know about it. So let me. And we can touch on promissory notes. Okay, legal lending. What is legal lending? Most people don't know about legal lending unless you are deep into the lawyer circle. Okay. Legal lending is to fund plaintiff in motor vehicle accidents who are guaranteed to receive payout when the case concludes but need money now. Okay, what does that mean? If you ever get in a car accident, you may have to have medical exam, expert reports. You may have to get off work, wait for the court to happen, wait for the court to open, wait for your trial to happen. If it goes through trial, then you get a payback, which is maybe a few months or a year or how many years later, right? You will get the payout because you are a plaintiff in an indisputable case, but how much you should get paid, that's going to be debated between the lawyers at the court, it goes to trial, etc. if it goes to that stage, right? So you need a bridge loan to live off in the whole process. Typically, each case needs about a few thousand, like 5 or 9,000 to like maybe 20, 30K as a bridge loan. Okay. Now, the lawyer representing the plaintiff will personally guarantee the loan. What does that mean? You lend the money to the lawyer who will lend the money to its own files. Okay? And as the files go through the courts and his clients, his plaintiff gets the money back, he'll pay. Okay? Why does legal lending exist? This is really interesting. Okay, so when personal injury lawyers go to court and they take on plaintiff clients, in order to fund their clients, they typically borrow the money from the legal firm's line of credit. By borrowing money from the legal firm's line of credit, when the case concludes and when the plaintiff gets paid out, the lawyer will get a cut into the compensation that's being paid to the plaintiff. And so, for example, if the lawyer borrowed the money from the line of credit from the legal firm, his cut in the profit might be 30% or let's say 20%. Let's say 20%. Just I throw a number out. Let's say 20%. If he borrowed the money from us, he didn't use the firm's line of credit, he will get paid more in terms of cuts, say 25%. So it's actually better for lawyers to borrow money not from his own law firm, but from us. So it's better return for the lawyers. Secondly, it's better return for us as lenders because if you don't have a really good relationship or know this thing exists, the law firm makes money by lending the money to its own lawyers. And lenders like us will never get an opportunity to earn the return the lawyer will offer because the law firm earned that return. So if we lend the money, we get the return. Okay, great for insurance companies because there's something called after event insurance. After event insurance will insure these plaintiff files. So essentially, the money lent to the lawyer is actually guaranteed by, it's double guaranteed. It's guaranteed by the insurance company, and it's also guaranteed by the lawyer himself or herself, okay? And we only do legal lending in BC. Why? Because there's only one auto insurance company. It's called ICBC, which is a Crown Corporation in BC. Whereas in Ontario, you get auto insurance anywhere. In BC, you get auto insurance only from ICBC, Crown Corporation. So there's only a handful leading law firms and lawyers in this space, and everybody knows each other. So we personally have a 10 years plus professional and personal relationship with them, with the head of the West Coast practice of the top 3 law firm in Canada. Okay, so how are lenders protected? The lawyers will personally guarantee the repayment of the loan, even if there's any delay in payout to any of the cases. If the lawyer were to leave the practice of law for any reason, the loan shall be immediately repaid plus interest to date of repayment. If the lawyer were to become disabled, the loan should be immediately repaid plus interest if not already paid. If the lawyer were to die, the loan would be tied to the cases and could be tracked and repaid when settled. The cases belong to the lawyer, not the law firm. Therefore, if he were to leave the law firm, they would go with him. Insurance company guarantees payout to plaintiff through the after event insurance program, and the lawyers and insurance both guarantee the payment. All right. Okay, another very important thing, even the question just asked me, but another important thing is the interest rate is 10% annually and it's paid up front. Therefore, okay, first of all, the lenders and lawyers sign contract directly, and the term is 12 months, open for renewal if you want. Rate is 10% annually. Upfront interest payments means, so for example, if you want to lend out 100K, you only have to send 90K, but the contract will still sign for 100K. You're getting that, so you should expect to get a full 100K back at the end of the term. All right, that's legal lending. Any questions?
Yeah, this is a quick questions.
Yeah.
What's the risk to lenders in the legal lending?
Yeah, the risk to the lenders really is if the good question. Really is if the lawyer disappears and you find out that the money is not dispersed to the cases, then the recourse is to sue, class action sue. Any other questions?
Yeah. I think you can, yeah, go to
Mick.
next slide.
Okay, great. So Mick. Okay, so if everybody knows about private lending, we'll jump into Mick right away. What is Mick? You cannot be called a Mick if you don't satisfy certain Mick criteria, okay? Mick is a cash flow financial product, typical form of mortgage securitization. Mick stands for Mortgage Investment Corporation. Okay, Mick acts as an issuer, and it pulls money together from its shareholders and subscribers, and it lends money as a pool to many different real estate assets. Mick can only qualify, okay, if you qualify for Mick, obviously you have to meet many criteria, then it's a tax-free, it's a tax flow through vehicle. So Mick will distribute 100% of its net income from the mortgages minus the fees to the subscribers. So Mick does not incur tax. All right. We talk about how, okay. Why Mick? So at first, when we started, we were simply just lending money on individual deals. Eventually, many of our lenders said this to us: man, I have to sign papers, I have to grab the deals. The deals go so fast. I went to take a shower, the deals are gone. Like I have to sign papers. Sometimes we have to manage skip payment. When there's part sale, we have to negotiate with the lawyers, etc. Too much work, even signing papers. Okay, fine. Is there any way I can just put the money in a pool? You take care of everything. And also, I don't want to have gaps between my deals. So when I lend individually, I lend money out, I take my money's back, I wait for another few months, I then can lend money out. I don't want the gap. I want my money always work for me. either a pool, we can just, the day my money goes into the pool, I can start earning interest. And if I withdraw money, I withdraw money. I don't have to sign more papers. I don't have to look at more deals. And I don't have gaps in my earnings. We're like, okay, that's a MIC. So we set a MIC. So this way you can diversify your portfolio. So instead of like lending a large amount on one single deal, you can put however amount you want over a large portfolio number of houses. There's no time gap. Your money always earns money. Also,
yeah. Sorry, someone also asked a quick question about MIC. Very interesting because somebody already emailed me directly and asking for some particular documents that they're probably very attracted by the MIC products, and they're just wondering. Quick question: how much does the exempt market dealers get paid in our MIC? Do we have any?
We do not use EMDs.
Mm-hmm.
We do not, because we are very small. We only set it up for the convenience sake of our existing clients. Mm-hmm. So we didn't incur the EMD cost at all.
Mm-hmm. Yeah, that's fantastic. Actually, save a lot of money.
Exactly. That's why we never went below 8%. We're pretty much higher, 1 or 2% higher than the market.
Mm-hmm. Right? And also, a lot of people can use RSP and TFSA directly to invest.
That's exactly. A lot of people have asked us like, oh, can we lend individual deals using tax-free account? I'm like, no, because why? Our deals go very fast. If you use RSP TFSA account, you are not able to make for closing. Time is too limited. We can't wait for you. But you can use RSP TFSA your room for MIC for sure. Yeah. Imagine your money doubling tax-free every few years. Anyways, any other questions?
Yeah, I think you can go ahead.
Okay. So what are the regulations? There's minimum requirement for operation scalability and stability. Every year, we are required to have a third-party auditing, and obviously we have to pass because we have to report it to government. I know a lot of companies in this field do not do this. We comply, okay? We do monthly dividend distribution, and obviously we diversify. Right now, our average LTV is under 67, and you can fund through tax-free saving accounts, RSP, TFSA, etc. Targeted yield 8%. Given the market right now, we actually are improving our yield a little bit as well. So we might get up to 9, but we'll see. Okay, how do you subscribe? We have a subscription package. Basically, the subscriber, so we can help you set up the accounts with Olympia Trust if you want to do RSP and TFSA, etc. You subscribe to the shares, capital goes to the MIC, MIC lends the money out, the interest come back to the MIC, and in the trust account, everything goes to the trust account, and then dividends are distributed to subscribers. We distribute every month between the 5th and the 10th. Sometimes we use TD, so sometimes the TD system is a bit slow. The pad takes a few days to issue, but typically the money hits your account between 5th and the 10th.
And everything will be signed digitally. So you don't have to go to meet with lawyers or anyone else to do all the sign work.
Correct.
So very easy to be set up directly.
Yeah. All right. Offer memorandum, subscription letters, subscription method, share certificate, everything's done digitally. Obviously, you're welcome to meet us, but I mean, sometimes just people like to sign papers at the comfort of their home. Yeah, so we do yearly audit, we distribute monthly. Redemption, yes. Typically, there's less than 1 year, you get a 4% redemption fee. If you withdraw between 1 to 2 years, you have 2.5% redemption fee. After 2 years, there's no redemption fee. Okay. We talk about this. How do you evaluate deal, appraisal, typical deal? We talk about this. Yeah. Okay. Any questions?
Yeah, I don't see any other questions come up. Right. So let's.
Okay, I'm gonna talk about what I see during COVID-19. All right. Probably for 5 minutes, and then open it up. Okay. All right. So COVID-19 is very interesting. Lending-wise, so debt-wise, like lending-wise, we have seen lower LTV, more first mortgages, and a higher return. So we actually have been lending more. Lending-wise, I think it's a great time. If you can, oh, I should not share my. Okay, yeah. So lending-wise, we see good deals. We see solid deals. If you cap your LTV 80 or 75 or 70, like sometimes we have 55, 60, like it's no brainer. At this point, you know, that beats stocks or any other things right now. Yeah. So we continue to do lending and do more. We compressed our LTV. But increase our lending activity. So that's and sometimes we're able to get 9 or 10 for low LTV deals. So that's you know, if people are looking at lending, you know, it's actually a good time now. All right. Same thing for MIC. We are actually thinking about increasing our rate because of the recent market change and deals that we see. We are able to compress our LTV and increase the profitability. So we might be able to flow more profit to the MIC shareholders. Okay. Conversion, very, very interesting. Before COVID, we we bid on every conversion property we can get our hands on. We never lose because we have very good strategy. But I expected that to cool down during COVID-19. However, I have recently looked at 3 conversion deals, and all of them fit our criteria, but all of them had 6 or 7 offers within a few hours of that project going public. Okay? What does that tell me? What does that tell you? Competition is less, but it's definitely there for conversion-wise, for conversion product. So we continue to buy. Also, the project which you guys saw the photo, the cross street neighbor sold during COVID-19 $50K above what we got a few months ago during COVID-19. All right. So conversion wise, have to follow through very diligently and have to act quickly as well. Multifamily, interesting. Multifamily is typically regarded as the most resilient asset class across real estate, and it showed this time again. Guess what's the collection rate under our portfolio? So in April and May, our collection rate is 92%. We have close to 3-digit doors. We're dealing with a couple of hundred tenants. Collection rate is 92%. All right. However, people are saying the cap rate might increase a little bit. And I do anticipate to see some distressed properties, distressed buildings coming out because we have lending side, we actually see distress and power of sale properties coming our way, which we always try to get our hands on. And we do anticipate to see, and we have already seen some distressed multifamily into default, and we intend to buy if the terms and the price are right. So it's a great time to actually scoop up discounted multifamily, to be honest. And that's what we're looking in the market for. Also, we have been in contact with, I know a few sellers who want to sell. To be honest, even during COVID-19, the most discount they would get is like maybe 3 to 5%. If there's no cash flow problem, they will not sell. Because multifamily is usually owned by rich old guys, sorry, rich old guys who have no cash flow problem and who can hang on it and enjoying great cash flow, all right? But I do think there will be some opportunities coming up. So I do think short-term wise, the news is really not accurate. Based on what we see, I do think there's dip in short-term wise in general. However, for what we are buying, for what we want to buy, for what we source for our investors, the competition is still there. People are still buying and prices still go up. Collection rate is still high. And oh, by the way, in our lending portfolio, there's only about, I think 10 to 15% have been asking for deferral, and they've all paid. So on both lending and on both debt and equity side, that's what we see on the front line. Maybe that's different than how everybody has experienced because we're targeting very specific asset and models. Any questions?
Yeah, Cindy, I think there's another question quickly about the COVID-19.
Yep.
So sorry, it's being covered. Okay, so the question is that what about the conversion multifamily? How is the COVID-19 impact? Is now a good time or better to wait for another 1 to 2 years?
Okay. Yeah, this is a question I ask myself every day because I see deals every day and I always ask myself that. Conversion wise, as I mentioned, we are getting back in because actually we see competition already. We also see, as I mentioned, even during COVID-19, the price has gone up for the specific asset that fit our criteria. So we're buying. For multifamily, I'm waiting for more distress coming out. Right now, people are not selling. There's no inventory. People are not selling. And the private who are selling privately, the discount is not in the range that I want. So, but I guess the next time you're gonna see a multifamily alert, you know it's a good deal. Now, wait. I don't think you should jump on every single opportunity, but I think you should jump on opportunity because equity. The reason why people want to own both debt and equity in their portfolio is because that is short term, but equity is long term. I do believe, based on what I see, the dip is temporary. Obviously, depending on when the vaccine is out, how everybody's handling, how the economy is doing, etc. I do think the dip is temporary. If you are planning to hold long term, you should jump on great deals. Now let me put it this way: based on what I see today, if you wait 2 years, you're not getting it. I can tell you, you're definitely not getting it. But should you wait like maybe 2 months, 3 months? Maybe. But definitely not 2 years based on what I see right now. Okay. I know it's a bit fuzzy because like nobody can predict the future. I'm simply drawing the conclusion as of today based on what I see so far today.
Cindy, there's another question I think you missed. We talked about when we talked about private lending, someone asked about promissory notes.
Yes.
Can we share more?
Sure. Yeah. Yes. Promissory notes. It's basically credit lending. It's basically personal lending, right? There's no collateral. You lend to people write you a promissory note, and if they don't pay back, you sue. That's essentially it. And yes, you're getting 12, 13, 14, 15%, or even higher for that. Correct. It's a very simple thing. It's a very simple thing. I don't know what particular that person wants to ask. But you have no collateral but you get a much higher return.
Yeah, I think all the questions we have answered and everything we have talked about. So let's start off F&Q. If you have any question, please quickly click on the option at the bottom of your window. Oh, sorry, there's another question. Oh, I think another question is that which I already answered, but Cindy, if you would like to share your opinion, I would like to have you answer it as well. The question is that what's the highest return I could get realistically on a first mortgage, maximum loan to value at 60% during the pandemic?
Where? If it's Toronto, 60%. What's the highest one? Somewhere between 8 to 10. So 10, you're super lucky. Also depends on how much capital. If it's a large first mortgage and the amount the amount is significant, you can land like $500,000, $1 million, 1.7 million, something like that. Yeah, you could probably get 9.5, 10 if there's no competition. If your money is limited, it's a small deal, maybe like 9, 8, something like that. So I would say between 8 and 10.
Okay, so please let me know if this answer, if this question answered correctly, and we will just wait for 2 to 3 minutes. Then we will start the FNQ part section.
Well,
so if
yeah.
you have any question, you can raise your hand, click on the button at the bottom of your screen. Then we will open your microphone and allow you to ask your question. And meanwhile, we have a polling section at the bottom of your screen. Please, there are 2 questions in this in this part. You can quickly answer it, select your preferences, and let us know. So in the next webinar,
we basically want to get our feedback. We want to know what time is good for you for next, like for future ones, and we also want to know what topics you want us to go into details with real numbers, real cases, more details essentially.
Yeah. Okay, I just started it, so you can make your selections. Thank you.
And whoever wants to ask in Q&A, like we can open the mic, so just let us know. Are there questions? Wow, easy crowd.
I think probably we have talked about everything in the webinar, and I have seen people are making the selections in the poll section. So yeah.
Right. Honestly, like we are full-time real estate investors. Like we make money by making good investment. So if you have any product you want us to investigate, or if you have any ideas you want to share, definitely let us know. And we're also gonna line up guest speakers in the future through our webinars, so we can learn. Like there are many models. I investigate a lot, like Airbnb, rent to own, all of that stuff, right? There's like pros and cons. There's like higher return, lower risk, higher risk, things like that. So we're gonna line up guest speakers for those as well.
Cindy, there's another question just to show up. So the question is that, have you looked at US multifamilies, which is higher cap rate?
Oh my God, this is a super good question. We have investigating many options across the border, one of which is US multifamilies, because, I can go on for days for this. US model is very different than Canadian models. US is a more cash flow model, whereas Canadian is a more appreciation play. And honestly, the difference is large, is significant. Sorry, what's the question? I wanna know what key points I want to hit.
There was people are asking. It seems the multifamily in US has a higher cap rate. Is that a good investment?
Haha, super good question. Okay, what does a higher cap rate mean? do you want your cap rate higher or lower? It all depends on which perspective you look through. If you are a buyer, you want cap rate as high as possible. If you're a seller, you want your cap rate as low as possible. Now, higher cap rate means what? Cash flow. Okay, so as I said, US is a pure cash flow play, whereas Canadian assets are more of appreciation play. Now, the reason why we decided to not go into US multifamily for now, okay, only for now, is because we actually analyze a lot of data and macro and microeconomics, etc. So there are a few things we noticed. One, if you look at a business cycle and economic cycle, I mean, we did the study before COVID, so nobody can anticipate COVID. So I'm strictly talking about before COVID. We felt US is at a later stage of their economic cycle and is heading into recession. Therefore, at that time, we felt going to US at that time wouldn't be a good idea. Okay. Also, the Canadian and US dollar exchange rate. So Canadian is very low at this point. Before COVID is also not very high. Again, we felt US was at a later expansion cycle. They're heading into recession. Canadian dollar isn't high. It's gonna work against us. So at that time, we decided not to go. But also the thing is, US multifamily cap rate is high, true. But because it's not too much of an appreciation play, you can get, like, we are already getting, if we just want pure cash flow and high interest product, we just do our lending and we already have that. Whereas in the US, I guess not, like, maybe people don't have that option to get high interest rate. Therefore, they are paying on multifamily to generate high cash flow for them, to get that high return, to get that high cash flow rate. So also because of that, we're like, yeah, at that time we decided not to do it. But if you are eyeing for US multifamily, there's like Arizona, Phoenix, there's a bunch of pockets which you should watch for, because those are the ones with like good population growth, good gentrification, demographics, good rent growth, etc. Right? But just at this point, with everything that we looked at, it's not a good time to own US multifamily. But eventually we'll get there when the time is right.
Yeah, there's another question. Now with during COVID-19, do you see potentially there are more deals in US which makes up the appreciation in a few years?
Okay, US, honestly, okay. I also invest in private equity, and some of them are US companies. I'll tell you how my personal opinion. I felt the volatility in US in everything they do in Americans is far greater than Canadians. So if a VC in the US is proposing some terms for term sheet, they would want blood, whereas Canadians, we're mild, like we want a fair deal. So volatility in US is significant. And I'm very conservative. So before I know for sure I'm getting a certain degree of return, or like, I'm not a speculator. So I don't bang on, my expertise is not betting on getting the best deal and getting the best deal and speculate that you will shoot up. It's not how I operate. Therefore, to be honest, I couldn't answer this question. I just feel even if I could gain significantly, I wouldn't trade it for the volatility that I'm going to face. Because I can get there by doing existing models with much less risk and much less volatility and still achieve the return.
Yep, I think we have talked about everything today, and I've received the feedbacks.
Mhm.
Thank you very much. And Cindy, do you still want to share a little bit more as the ending of the?
No, just I really appreciate you guys taking like part of an evening to like hear me share about how we did it and our experience. I really appreciate it. So as I said, like our dream is to help other people achieve financial and time freedom. So, you know, I really thank you for taking the time and hear what we have to say. And hey, some of this may be interest to you or may help you achieve your goals. And I'd love to see that. Yeah.
Fantastic. Okay, so thank you for joining our webinar today. And we will upload this recording to our YouTube channel, which I also shared with us in the chat panel. You can just quickly subscribe to our YouTube channel at Cindy Bice. Then you can see the recorded video of this webinar as well for playback. Okay, thanks again for joining us today. Wish you have a good night. Thank you.
Thank you, everybody. Thank you. Till next time.
Bye.